Good morning, everyone, and thank you for joining me today. We are going to take a deep dive into some long-term care alternatives for your clients. My name is Nicole Blaine, and I am with Insurance Agency Marketing. First thing we're going to go through are some housekeeping items. We're going to talk about IMS Business Builders and our referred producer program. If you refer an agent to IMS, when your referral contracts with us, you will receive a $50 bonus. When your referral writes their first piece of business, you will receive $100 or 20 basis points, whichever is greater. And then we will continue to pay you a 20 basis point override on all of their business. It doesn't come out of their pocket or yours. It's our thank you to you for referring a producer. Just as your business is built on referrals, so is ours. Also need to talk about our marketing reimbursement program. So after you have completed your first 180 days and collected your new producer bonus, we do have what we refer to as our marketing reimbursement program. We pay $100 in marketing reimbursement money per $100,000 of premiums submitted. It is our way of helping you cover the costs of conducting business. The next thing we're going to go over are our new producer builders. We have set up some new levels for 2020, which is nice for you. As you can see, the $100,000 level will get you a 1,500 piece postcard mailing, pre-formatted emails, a marketing analysis, corporate identity package, or $750 in cash. The $250,000 level gets you a 3,000 piece mailing, $2,000 in your marketing reimbursement account, a $1,500 Visa gift card, and all the rest of the levels, as you can see. I'm sorry, I skipped a slide. Okay, so here at IMS, we are known for our back office support. We are your back office, from case design after you meet with your client to explaining the products to you if you're new to the business, getting you all ready for your appointment with your client. We have business building tools and resources on our website under our sales resource library. We also have forms at your fingertips on our website. We do follow up. Once you submit your case to IMS, we will scrub it and then follow up on it every 3 business days to ensure that it does get processed in a timely manner. And we do have a 24-hour turnaround time on quotes that is guaranteed. We have top sales expertise and coaching available for you, as well as paperless contracting. Our creative marketing department is something that we have really expanded going into 2020, and the resources available to you are limitless. We have turnkey solutions for postcards and newsletters and flyers, anything that you would want to send out to your clients. We are able to do logos, branding, business cards, brochures, stationery, and advertising for you, whether it's through your website, through Facebook marketing, or LinkedIn. And then we have digital solutions as well. So we can build you a website. We can implement digital marketing strategies for you. We have social media consulting, email marketing consulting, and online newsletters. Our IMS website is a wealth of information. Under our sales resource library, there isn't a topic that is not discussed that you can click on and learn about. You can do term life quotes, you can run income rider quotes, you can access all the forms that you need 24/7. We have links to the industry. Our current annuity newsletter is on there. We have an annuity grid and a long-term care product grid on there as well. You can also access our e-app for annuity or life insurance policies through our website. It is just an excellent source for you to make conducting business easier. IMS Wealth Management is a division of IMS that we started about 3 years ago. It does require a Series 65. We do manage money fees. It is an excellent way if you do have a Series 65. If you have a client, let's say, that has a $500,000, and because of suitability, the annuity will only take 300,000 of it. It just gives you another avenue to place their funds without having to give that business away to another advisor. Our Life and Annuity Academy is going to be coming up May 6th through the 8th. It will be held at Athene's home office in Des Moines, Iowa. These are an excellent opportunity for agents who are active in the life and annuity markets looking for ways to increase their sales. We do bring in our top 4 producers. They go through everything from Social Security seminars to the infinite banking concept. It is a wealth of information in a 2.5-day seminar. If you would like to register for the Academy, I know we did send out an email on it today. Check your email boxes and go ahead and complete that registration form, and we will follow up with you. Our montage trip. This is exciting. So the invitational period began July 1 and it runs through June 20th. It is a 4-day marketing summit at a very pristine resort in Los Cabos. Great getaway and learning experience as well at a beautiful location. And then our Puerto Vallarta trip is qualification same time, almost July 1st, 19 to December 31st, 2021. Oops. 3.5 million trip credits is what is required for our IMS Marketing Summit. You will stay at a incredible resort and top level advisors will be there, so it will be socializing as well as learning. Great opportunity there. And then if you can hit 6.5 million points, you get to go for another 4 days to the Punta Mita Elite level trip. And this is a very, very exclusive resort that I am sure you would enjoy. Okay, so why are we talking about this? We are talking about this to offer clients an opportunity for better income. We're able to help clients maximize their assets in the event of unforeseen circumstances. And because of the increased competition in this market space, we are seeing a lot more innovative products available. What your client can expect is an opportunity for increasing payouts if at some point they would be unable to perform 2 of 6 ADLs or be confined to a skilled care facility. And it does give them the ability to retain control over their assets while receiving their income. And they can enjoy an income as long as their retirement does. And it is an income that they cannot outlive. Okay, so here are some statistics that I found very alarming when researching to put together this webinar. 67%, as you can see, of Americans have done little or no planning for any type of event that would require any type of long-term care. And the statistics show that 2 in 3 people feel that the country is not prepared for the older population. 86% believe that the government should help pay with the costs. And 57 think they will rely on Medicare completely or quite a bit. Now, we all know that Medicare is not going to cover very many skilled care facilities. Here is another statistic I ran across that I want to share with you that you can share with your clients. So, how long are we going to live? For men who reach the age of 65, 75% of them will live to be 79. 50% will live to be 87, and 25 will live to 93. At some point in there, I'm guessing that they are going to need either some assistance with 2 of 6 ADLs, or they might unfortunately be confined to a skilled care facility. The statistics for women are even more alarming. For women who reach the age of 65, 75% will live to be 82, 50% will live to age 89, and 25% will live to age 96. And the most alarming statistic of all, 50% of marriages have at least one spouse that lives to age 93. Okay, so the first product that we are going to go over is the F&G Accelerator. The issue ages on this policy are 18 to 85 for qualified funds, 0 to 85 for non-qualified, and the minimum premium is $10,000. Income can begin 1 year after issue. They do accept qualified and non-qualified funds, and they do have single and joint payout options available. The rider fee on this is 1.25 basis points annually. It does have a vesting bonus that vests over the 10-year period, 10% end of each year, only on premium paid in year 1. And then it does have state variations as well. But most states do have a 6% bonus on this product. Withdrawals. Okay, so this is where we really want to focus. This in the next slide. The income base is what the withdrawals are based off of. When payments are turned on, the amount is the percentage of the total income base. So at age 50, a single annuitant would receive 3.5%, a joint would receive 3%, and then it increases by 0.5 every 5 years to age 85 that they defer starting their income. If it's joint, it increases by 1% every 10 years to age 80. Now, down here, it discusses the qualifications for impairment and the account value reaching 0. So what happens in this product is that the income will double for up to 5 years or until the account value has reached 0 if your client is unable to perform 2 of 6 ADLs. And that has to be certified by a licensed physician and requires the care of a licensed caregiver. The impairment must begin after 1 year of the contract being issued, and it has to be expected to be permanent impairment. And the annuitant must be at least 60 years of age or older. So this page just goes over the doubler. If the annuitant meets the qualifications for impairment, the account value is greater than 0, payments increase by 2 times. If it's a joint contract, it increases by 1.5%. The enhanced minimum withdrawal benefit rider has been in effect for 3 years. No premiums have been paid for at least 3 years. The annuitant is unable to perform at least 2 of 6 ADLs, and the impairment began 1 year after contract issue, and the client, again, is older than 60 years old. So what is this going to cover? After the first contract year, the client can't perform 2 of 6 ADLs, the doubler will kick in. The nursing home care must be in a licensed nursing home after the first contract year, and they must be confined for at least 60 days, the doubler will kick in. The terminal illness diagnosis must be made after the first contract year and certified by a licensed physician, and their life expectancy must be less than 1 year. At that, the terminal illness waiver gives them their account value with no surrender charge or MVA. So let's take a look at these numbers. So on $100,000 on a 65-year-old turning on income at 67 in year 2, the annual withdrawal is going to be $5,512. Should they be confined at that point or unable to perform 2 of 6 ADLs, they would receive $11,025 for 5 years or until their account value reaches 0. So as you can see, the minimum guaranteed surrender value when they're taking income in year 5, they still have $64,000. So likely they are going to be able to utilize the full 5 years of the doubler. And then what happens is the income payment reverts back to the original income guaranteed in the policy of $5,512. So it provides your client with some peace of mind knowing that for 5 years they will have an enhanced benefit to cover any costs they might incur for any care coverage that they might need. And here is another example. Same thing, $55,512 for the income, $11,025 for the enhanced payout. And you can also see the death benefit stays fairly strong throughout the contract. Now, this Barclays Trailblazer Sector 5 Index is what I like to allocate to. I was just informed that no one can see my screen. I do apologize. Okay. Can everybody see my screen now? If somebody could type yes in the question box. Okay. Well, thank you guys. Okay. Do you guys want me to go back to the beginning? Can I get some yeses or nos? I'm getting a whole lot of yeses. Okay, we're going to go back then. We're not going to go back to the IM slides, though. We're just going to start at F and G. Okay, so here is the minimum premium, $10,000, like I said. Issue ages, non-qualified, 0 to 85, qualified, 18 to 85. The rider fee, which is important, 1.25 basis points, and you can have single or joint annuitants on this policy. The vesting bonus is 6%, vests over the 10-year period. There are some state variations, as you can see over here on the left. The other states, the vesting bonus is 4%. Withdrawals. So at age 50, the withdrawal percentage is 3.5%, and it increases by 0.5% every 5 years up to age 85. If it's a joint payout situation, it's 3% and increases 1% every 10 years to age 80. Next slide is going to talk about the qualifications for impairment. So as long as the account value is greater than 0, the client will receive double income payout with the enhanced minimum withdrawal benefit rider. It will double their income for based on 2 of 6 ADLs for 5 years or until the account value is at 0. I'm getting quite a few. Show the demographic screen. I'm sorry. I will go back to the demographic screen at the end and go over that with you. Okay, we're going to continue with the F and G. So this covers home health care, nursing home care, and then if your client should become terminally ill after the first contract year, they will be able to access their account value with no surrender charge or MVA. Here is the illustration that does show the enhanced guaranteed withdrawal payment as well as the annual withdrawals. So for a 65-year-old male, $100,000 premium, the annual payout is going to be $5,512. And with the enhanced payout, they will receive $11,025 for up to 5 years or until the account value is 0. And as I was stating, if they turn on income, as you can see in year 2, they have a $93,694 vested account value. So they would, if an incident occurred fairly early on in the contract, they would be able to utilize that 5-year of doubler, which does give those clients the peace of mind of knowing that they do have a little bit of something. They may not have a long-term care policy, but they do have extra income in place in the event that they should need some sort of care, either by a home health aide or a nursing home care provider. Here is the illustration. It's a little bit larger, and as you can see, the death benefit on this policy is pretty decent as well. Again, 5512 is the payout. 1125 is the payout with the doubler for up to 5 years or until the account value is 0. And this is where I was notified that you couldn't see my screen. So we're going to talk about this Barclays Trailblazer Sectors 5 Index. I am a huge fan of this index because it came out in 2016. So 2016 to 2018, these are not hypothetical. These are actual returns. 2016, it has 7.8. 2017, 11.71, and 2018 it was down 6.82, but in an annuity, remember, 0 is your hero. So they wouldn't have gotten any interest credited. But as you can see, I mean, we've got 8.06, 0.51, 10.38, 9.93. This definitely has the potential in good years for some very, very high account crediting. This policy does utilize some S&P strategies as well as that Barclays Trailblazer that I just mentioned. And then these are the payout percentages. So 50, it's at 3.5. If we jump up to age 60, we're at 4.5. At age 65, 5.25. If they hold off till 70, they're at 6%. Maybe not the highest payout percentages in the world, but that doubler based on 2 of 6 ADLs is pretty appealing to clients, and a lot of clients do like to have the peace of mind of knowing that they don't have to be confined to a skilled care facility to receive a doubler on their income. Next product we are going to go over is the EQUITRUST Market Power Bonus. This product does have a 10% bonus that is fully vested on day one. Income is available 30 days after issue. It does take qualified and non-qualified funds and does have a single or joint payout option. The rider fee is 1.25 basis points as well. So here is the breakdown on the income rider. It guarantees a lifetime income based on 6% accumulation. For up to 10 years, the rider has an annual charge of 1.25 basis points. The income rider must be elected at issue, and the owner must be at least 40 years or older. Lifetime income withdrawals continue even if the accumulation value is 0, so it's an income that they cannot outlive. The rider fee we went over, 1.25 basis points. The income withdrawal amount is increased by 100% for a single owner and 50% for joint for up to 5 years in the event of chronic illness. Chronic illness is defined as the client being unable to perform 2 of 6 ADLs or some type of permanent cognitive impairment. At the start of the enhanced benefit period, chronic illness the diagnosis must come from a physician and it must be certified annually. The enhanced benefit does not impact the lifetime payout amount, and the annuity must be in effect at least 3 years and have an accumulation value of greater than 0. The income withdrawal amount equals the benefit base multiplied by the income payout percentage. The benefit base includes all premiums and premium bonus, less withdrawals compounded. And as you can see, the income withdrawal percentages. So at age 50, we're at 3.25. At age 60, 4.25. And age 70, we are at 5.25. Now, what this policy does allow you to do is start and stop the income, which most policies do not allow for. So although it does have lower payout percentages, if you have a client that thinks they may want to take income for a couple years, turn it off, turn it back on, they do have that option. Okay, so further on with the income rider, the accumulation value is greater than the benefit base when the income withdrawals start, and on each subsequent contract anniversary, the benefit base will be increased to equal the accumulation value. This allows for the income withdrawal amounts to potentially increase from year to year. Here it talks about what I was just referring to, starting and stopping the income withdrawal. The owner has the ability to start and stop income withdrawals when they choose. If income withdrawals are not stopped and the rider is not terminated, the payments will continue for the owner's lifetime, even if the accumulation value is 0. If withdrawals are stopped and later restarted, the payments will be the greater of the prior income withdrawal amount, adjusted for any excess withdrawals. So if they wanted to access 10% at one point during a year, and the original income withdrawal percentage is multiplied by the current benefit base. EQUITRUST does take additional first-year premiums, and that will increase the benefit base, as well as they will receive a 10% premium bonus for any premium added within that first year. Excess withdrawals exceeding the income withdrawal amount are allowed at any time, but will reduce the benefit base and the amount of future income withdrawals proportionately. And If it is above the penalty-free withdrawal amount, it may be subject to surrender charges and MVA. RMDs are not considered excess withdrawals. The rider may be terminated at the owner's request. So let's say you have a client who gets into this product and decides 5 years down the road, hey, I don't want to keep paying this 1.25 basis point. I just want to let this product grow. They do have the opportunity to do that. The rider will also be automatically terminated upon death of the first contract owner unless a spousal continuation is elected. That is important to talk to your clients about. So let's look at EQUITRUST. We're still looking at about the same income withdrawal amount. Starting income, this one you can start income immediately. I just wanted to make all of these illustrations proportionate, so I started them in year 2. The guaranteed withdrawal amount is $55.39, which would be $11,040 if they needed the doubler added to it. You can see the rider charge, which is nice. You can show your clients on the illustration how much they're being charged every year, and then the death benefit as well. And again, just another illustration, $55.39 with $11,040 being the enhanced payout and the death benefit to show your client. The next product we are going to talk about, the doubler is based on confinement to a skilled care facility, and the minimum premium for this policy is $25,000. Income can begin 30 years after issue. They accept non-qualified and qualified funds, and they have single and joint payouts. The rider fee is a little less. It's 1.1 basis points. And this product, just so you are aware, does have a multiplier that can be purchased. You can do the increasing income product on it as well. But for simplicity's sake, to show and compare numbers for doublers, I did the fixed guaranteed income payout. So your annual income is magnified by 200% in the years that you defer your income. So let's say in year 1, you don't turn on income. Your interest credited rate is 4%. With that 200% multiplier, you are going to get an 8% annual income credit. Double your interest earned to help maximize your income potential. Again, we are referring to the 200% multiplier during the years of deferral of the income on this contract. So once you do turn on the income, you're going to get credited whatever you earned. So if you earn for 4%, you're going to get a 4% annual income credit, which then $104,000 will be your starting point for future lifetime payout withdrawals. Match your interest earned for more income potential even after the withdrawal begins. So this is hypothetically assuming that you earn 5%, you'll get a 5% increase in annual income. This is referring to the multiplier because I do want you to know that this product does have that option. We like to use it for a hedge against inflation, and the multiplier product also has the confinement doubler. Okay, so for $100,000 in premium at an issue age of 62 and a 5% withdrawal beginning at 67, Gary earns income credits that are equal to double the interest earned before withdrawal. Then once he turns on income, he's going to earn whatever is credited. and then his income base is locked in for life. AIG utilizes PIMCO, the Merrill Lynch Strategic Blend, and S&P for their strategies to allocate to. And here is a sample illustration. As I said, I did not do the multiplier, the AIG Power Select Plus Income Multiplier, because I wanted to show apples to apples. So we're just doing fixed payout. So let's say the client turns on income at age 66. Their income payout for the rest of their life is going to be $5,250. With that doubler for confinement to a skilled care facility, they would get $10,500 for 5 years or until their account value is at 0. And AIG also shows the death benefit for the client to take a look at. So this one is showing they're turning on income immediately. It drops it a little bit. They'd get $5,100, which would translate to $10,200 in the event of being confined to a skilled care facility. Now, here is AIG's newest addition to this product, the Enhanced Income Benefit Confinement Waiver. On or after the activation, Lifetime Plus Multiplier Flex can provide enhanced income of up to 200% of your client's withdrawal amount if they are confined to a qualified care facility such as a nursing home. This increased income will not be treated as excess withdrawal. So, for example, as I showed in my illustration, if they're getting $5,100 as an annual income, they will then receive $10,200 per year without affecting future benefits. Once that 5-year period is up or their account value has gone to 0, their income payment will revert back to the $5,100. And then you can see the payout percentages. AIG has a little bit higher payout percentages than most carriers. They do kind of have an edge on that. However, to utilize the doubler, the client does have to be confined to a skilled care facility, which most people prefer the option of the 2 of 6 ADLs. But the payout percentages are quite a bit higher at 4.35 at age 60 and 5.85 at age 70. Now, the last product that we're going to go over is strictly a long-term care product, because you do have clients who maybe have a lot of money in annuities. They're not going to meet suitability. They're looking for some long-term care. They don't want to pay an income rider fee, but they do want to be covered in the event of a long-term care incident. The One America Annuity Care is that option for that client. The minimum premium is $10,000 and it issues through age 50 to 85. The long-term care benefit is available after 7 days. They take non-qualified and qualified funds, and they do have single and joint payouts. The rider fee is not applicable because this is a long-term care product. So you can run a full illustration on this, but the main page that you do want to focus on when you do meet with a client about One America's Annuity Care is this page of the illustration, because it shows the initial long-term care accumulated value, the benefit, the monthly benefit, if they add the inflation protection, the waiting period, and the premium. So what I ran was on a 65-year-old male with the continuation of benefit rider for a lifetime. So they're going to have lifetime coverage of $2,567 per month for all the years that they need it if they are unable to perform 2 of 6 ADLs, if they are confined to a skilled care facility, whatever the case may be. This policy covers any type of care that they might need, and all it requires is their physician submitting documentation to One America. The other nice thing about this One America product is it is a reimbursement product, so whoever they are receiving the care from submits the bills to One America, and One America does reimburse the company providing care on a monthly basis. So the client doesn't have the headache of paying when they're already sick. They don't have to worry about cutting checks for the care that they are receiving. Here is a full illustration of the One America product. Now, the long-term monthly care benefit is the 2617. It shows the accumulated value and the cash surrender value. If something should happen to the client during the contract and they have not utilized their long-term care benefit, the accumulated value would be the death benefit, or if they've utilized a portion of the long-term care benefit, the accumulated value minus any benefit payouts would be their death benefit. So here is an overview of the One America annuity care. The policy issue ages, as I said, are 50 to 85. The minimum premium is $10,000. It does vary by state. The maximum is $500,000. It is like a typical annuity contract, so it does have surrender charges. You can, at any time after the first contract year, access 10% free withdrawals with no surrender charges, just like a regular annuity. However, partial surrenders will reduce the amount available for long-term care and may be subject to surrender charges. Surrender charges are waived, obviously, if the owner of the contract or the annuitant should die, and they will also be waived upon the death of the surviving annuitant if it is a joint policy. Clients can access their long-term care fund of their annuity by qualifying in one of two ways: the inability to perform 2 of 6 ADLs or severe cognitive impairment. To be eligible for benefits, the annuitant must be chronically ill, and if funded with non-qualified money, with qualified long-term care services provided pursuant to the plan of the care prescribed by a licensed healthcare practitioner. There is a 7-day waiting period, as we discussed, and the types of care covered. So here's where this long-term care policy is going to differ from an income annuity. This is going to cover hospice care, respite care, bed reservation, adult daycare. If the annuitant wants to stay with his children or a family member, but they need some extra help because the caregiver does have to go to work every day, whatever the case may be. This policy even covers adult daycare. It also covers home health care, assisted living, and nursing home facilities. As I stated, it is reimbursement, so actual long-term care expenses will be paid from the long-term care fund up to the amount of the monthly benefit limit. The monthly benefit limit is calculated by dividing the long-term care fund balance at time of claim by 34.5, and the maximum, or the minimum, I'm sorry, is 36 months. That's what the standard contract buys you. But you can add that continuation of benefit rider on there for a lifetime of coverage. Interest rates will be credited to both the accumulated and the long-term care funds. We do have the rates change just like on annuities, so you do have to, whatever the rates change to for the year will be applied. The continuation of benefit rider, the standard policy is 36 months with an extension of long-term care benefits available. That is available in most states, not all, and is good until the long-term care benefit has been exhausted. All right, I'm gonna go over here to my questions box. It doesn't look like I have any. I will be following up with each of you after the conclusion of this webinar. Hopefully I will get to all of you today. We've had a lot of people on here, so it may not be until tomorrow. I do apologize for you not being able to see my slides initially. For those of you who want to stay on while I go back to the beginning slides with the statistics, I'm going to do so now. The rest of you, thank you so much for taking time out of your day and joining me on this webinar. And as I said, write down your questions. I will follow up with you and answer any questions you might have at the conclusion of the webinar. Okay, so we're going to get back up to the beginning. Okay, so for those of you who are waiting to see the statistics, the first statistic page that I had, I found two pages that I found kind of alarming. The first statistic that 67% of people have done little or no planning for any type of long-term care event they might experience. 86% of people believe that the government should help pay with the costs, which we all know is likely not going to happen. 56% of people believe that Medicare should be responsible for the cost of long-term care. 57% erroneously expect to be able to rely on Medicare to cover their long-term care needs and think that they can rely completely on Medicare to cover their long-term care expenses. This was the next page of statistics that was alarming to me, and it's concerning life expectancy. So for men who reach the age of 65, 75% of those men are likely to live to age 79. 50% are likely to live to age 87, and 25% are likely to live to age 93. For women, it's even more alarming because 75% are expected to live to age 82, 50% are expected to live to age 89, and 25% are expected to live to age 96. Now, between 80 and 96, most people are going to have some sort of need for one form of care. And then the other alarming statistic that I ran across is married couples. So 50% of marriages have at least one spouse that lives to age 93. These are all really good pieces to put in front of your clients to help them realize the significance of preparation for the event of a long-term care circumstance arising in their life. Are there any other slides that anybody wants to see? I'm going to my question box one more time. Is the enhanced income for care coming out of the gain first, all taxable, or part gain, part principal? Okay, all of these longer, extensive questions I will ask when I follow up with you. I have shown the demographics with the life expectancy again, and it looks like that is about it. So with that being said, I am going to conclude this webinar. Again, I apologize for you not being able to see my first set of slides, and I do sincerely appreciate you taking time out of the day to join me on this webinar. Write down your questions. I'll be following up with you and look to speak with you shortly. Have a great day.